Hey there, everyone. Happy Thursday. It's Dave Keller here with Market Misbehavior. Welcome to Chart This, coming to you from we'll call it overcast Redmond, Washington. We're getting rain here later in the day. Not a lot of rainy weather feel to the markets today with the S&P, the NASDAQ, the Dow all finishing in the green. We had a bit of a hint of some negative vibe yesterday with a lot of the sectors closing lower, with the McClellan oscillator dipping below zero. If you remember back to recent weeks, we were talking about the Hindenburg omen. So one of the Hindenburg omen confirmatory signals, I guess, would be the McClellan oscillator rotating below zero. We didn't get enough new lows to qualify as a valid Hindenburg omen signal. With today's sort of brief rally, I would expect that to still be pushed down the road, if at all, here. So we'll continue to monitor that. Overall, nice risk on day with materials at the top of the list again, which has actually happened a couple times now in the last week. And this is one of the benefits of doing a show and calling out leadership and laggardship, because you start to remember themes over time. Now, energy in a familiar spot on the bottom of the list. As we get through some of the charts in our show today, you'll see how a lot of the energy charts, have not been looking particularly strong for quite some time, but really starting to accelerate to the downside here as crude oil prices continue to underwhelm. With that in mind, let's continue here with the market recap. Look at how the charts evolved from Wednesday's close through today's close here on Thursday. The S&P 500 finished today just about 57.45. That's up about 0.4% from yesterday. The NASDAQ composite, even better, up 0.6%, about the same for the Dow, which finished just below 42,200. Mid caps, small caps, all up. The S&P 400 mid cap index was your top performer out of that group, up almost 1%. Now, the VIX did move slightly higher, and I think this is a perfect reminder of what I often like to point out. We tend to think of things like the S&P and the VIX as having this perfect inverse correlation, meaning if stocks are up, volatility's down, and if stocks are down, volatility's up. Over time, and with a lot of, over multiple cycles, that's generally been true. But remember, that is a generalization. On any given day, on any given week, the market can go higher with elevated volatility. The market can go down with lower volatility. And I think it has a lot more to do with the types of stocks that are moving, just the nature of the market environment during that particular time. So don't be surprised by the fact that the market did go higher. The VIX didn't drop down to 12 or 13, still about 15.5. And as a reminder, the VIX sort of in that 15 to 16 range. That's a low volatility environment, sort of low risk, low uncertainty. The markets are in court in terms of volatility is telling you not too much to worry about just about yet. Looking at the bond markets, you can see that rates overall were a bit higher earlier in the day, but bonds rallied going into the close. And so the 10-year yield pushed a slightly higher. But to be honest with you, no real change from yesterday. 10-year yields right around 3.8%, 5-year point around 3.5%. We'll call it the long bond yield, just about 4.1%. The dollar did move slightly lower today. The UUP is down about 0.4%. That's a bullish dollar ETF. Gold and silver, both in the green today. The GLD, the SLV, which are the two ETFs we track there, were up 0.5% and 0.7% respectively. We've talked about that long-term uptrend in gold just continuing to persist. I don't think I included this chart today, but we might save that for the mailbag show, which will be on Friday of this week. So don't miss that one. I've always enjoyed getting a lot of questions from you. As a reminder, I do see the comments that you're putting in as we broadcast this live on Facebook, on YouTube, on X. So please pop questions in as you go. Time permitting, I'll try to take a question or two at the end of the show. If I don't have time for it, which I often don't, I will save those. We are planning a mailbag episode Friday of this week, and I'll happy to answer some of the questions we received on the shows this week and give us a chance to dig a little deeper, a little more thoughtfully into some of those key answers. But one of the questions I did receive this week was about gold versus the dollar. So for today, dollar a bit weaker, gold a bit positive, with the GLD up about 0.5%. Copper prices up pretty good as well, just over 3%. Crude oil in the red. And as I mentioned, energy, your worst performing sector here. The USO was down about 3.5%. Bitcoin really kind of resuming in some ways this uptrend. We're going to look at a chart of Bitcoin in a minute. I don't know if we can declare this as a clear uptrend just yet. We finished today just below, or currently as we're going live here, it's just below 65,000. It was sort of that back of the envelope level we had been talking about. That lines up with the previous high over the last month or so. And again, I think the benefit of that line in the sand approach, you define a level of where you, agree to change your thesis, change your position, take action of some sort. For me, 65K, that's sort of the level. We can power above there and get a foothold above there. I think we might be going somewhere, maybe retesting those previous highs. As you can see here, over the last 6 to 12 hours, we did push almost to 66,000. But as we're going live here, we've dipped right below that 65,000. So for now, that level of resistance appears to be holding steady. Looking at the 11 S&P sectors, we can see, let's see, materials at the top of the list again. I think that was yesterday as well, up 2%. Technology, number 2, that's 1.3%. Communication services, up 0.5%. Only 3 of the 11 S&P sectors down. Energy, as we mentioned, your worst performer, that's down about 2%. Real estate and utilities, 2 pretty defensive sectors. Low volatility, higher dividend paying groups, down 1% for REITs and 0.7% for utilities. Looking at the Magnificent Seven and Friends kind of growth leadership names. And again, even if you don't have active positions in charts like this, these are the types of charts I always want to just know. And this is a lesson I learned from my analysts at Fidelity years ago. I had analysts that covered each of the 11 S&P sectors, others that covered different groups like small caps and international stocks. The analysts that covered individual sectors knew those charts intimately, particularly the big, well-known and widely held names in those sectors. They knew the charts cold. They knew the charts without even seeing the ticker. They would know, that's Apple, that's Microsoft, that's Johnny John, whatever it is. And so I think I would encourage you, even if you don't hold a position in Apple or Alphabet or Microsoft, get comfortable with these charts because these dominate our benchmarks. So goes these charts, so goes the benchmark, would be my generalization with these charts. Kind of a mixed bag today. Alphabet was up almost 1% today. Apple up about 0.5%. Netflix down actually 1.4%. Tesla, which has been probably the best performer here in the last month or so in terms of the most constructive price action, I would say between Tesla and Meta, it's probably an arm wrestle between the two. But Tesla down today, just about 1.1%. So kind of a mixed bag of sorts, I would say, generally speaking. Let's get to the charts here to continue on our discussion. Before we do that, I'm doing to show you what we call the market carpet. This is a heat map sort of showing you the different areas of the market. You'll note if you've been following the show here as we've launched things over the last week or two, this is a little more a mixed bag of sorts than I think we've seen on previous days. You'll note, takeaways from looking at this, immediately my eyes, I don't know about you, my eyes are drawn to the energy sector in terms of where the most red is, right? The concentration of negativity, if that's a phrase to use, is in the energy sector today. Followed, I would say, after that, probably by real estate and utilities as the least positive. In terms of the most constructive, the most green, you see a lot within technology, but it's notably not the big stuff, right? It's not the Apple, Microsoft kind of names, which were horrible, but weren't really getting it done compared to AMD up over 3%, Applied Materials up over 6%, Micron up another 15%. Obviously, Micron with earnings this week. And so, sort of propelling a lot of semiconductors up today. We did talk about those charts and others on the show yesterday if you missed it. I would also say just generally, again, some of the biggest names, not the biggest gainers today. I think there's plenty of green on this heat map. It's just not in some of the largest boxes. And what that tells you is it's not the mega caps dominating. It's some of the smaller names within the S&P 500, which is the universe that we're looking at here. Great way to use this, by the way, is to just focus on areas of strength, focus on areas of weakness. Those are sort of the barbells, right? If sort of most stocks are kind of in the middle somewhere, what moved up a lot, what moved down a lot, dig into those names and see what sort of ideas you can stir up as you're reviewing the market dynamics. All right, let's continue on here looking at a daily chart of the S&P 500. So it was interesting as we gapped higher at the open, highest open on record above 57.50 for the first time. We did not get a close above 57.50, while today was a record high close for the S&P 500. It was just about 57.45, so we did close below the open. Reminds me of the chart of Microsoft that we highlighted recently with a lot of down closes, meaning we close below the open. And while that's not an end of the world kind of dynamic, it does tell you a little bit about the short-term sentiment day in, day out, as you see people opening or see the market opening and then selling coming in through the course of the day. So even if we gap higher, you're seeing distribution through the course of the day. That's a short-term read, but again, sort of notable that we did open higher and close back right around the highs for yesterday. Having said that, I would say the primary uptrend by my read is clearly positive, and the reason why I would say that is because we were making a clear pattern of higher highs and higher lows off of the August low. What I like to do when the chart is, in an uptrend, I like to think of it as innocent until proven guilty. As a trend follower, I assume that a trend is going to persist, and I just love having very clear levels or signals or patterns that would tell me whatever trend is in place is most likely changing. So what's that trigger? What would be that signal on the chart of the S&P? Two things that come to mind. Number one, the breakout above 5650 was a key moment because that was the high in July. That was the high in August. It looked like a double top. Then it looked like a potential triple top. And that was broken out. We actually broke to a new all-time high here about a week ago. Support or resistance often remains important. So resistance often becomes support. Support often becomes resistance. That's why I have this horizontal line here right around 5650. It was a long-winded way of saying as long as we hold about 5650 here in the coming weeks, conditions are great because we're making higher highs and higher lows. Now, that higher low thing is important because what you look for is to see when we break trend lines, right? So we have a trend line from the low in August, the low in September. That's currently sitting around 55.25. But if we, take a couple weeks to get down to that line, that could be up in the 5,600, 5650 range, which means as long as we hold that on any pullbacks, the primary trend remains positive. If you want another example of what we talked about yesterday's show, we talked about the TLT bond prices, how they're making higher highs and just pulling back here in the last week or two, making arguably a potential higher low, maybe setting up for the next move higher. So the trend in stocks is positive. The trend in the benchmarks is positive. Let's talk a little bit about sentiment. A lot of sentiment data, survey data in particular, comes up on Thursday. So earlier in the day today, we got the latest AAII survey and the latest name exposure index readings. Let's go through each of those one by one. Here we're looking at the AAII survey. This is a weekly survey of individual investors. They are asked, are you bullish, bearish, or neutral on stocks for the next 6 months? You can see that this week, almost identical to last week. No real significant change in terms of the percentage of bulls. It's just slightly below 50%. Now, with a sentiment indicator like this, I kind of use it in two ways. Number one, what's the reading and how does that compare to previous points in the cycle, right? Are we at a level of sentiment that is consistent with bull phases or bear phases or something like that? The second question would be, are we getting to an extreme? Are we getting to an extreme level of bullishness, what I would call a euphoric level? Or are we getting to an extreme level of negativity, extreme bearishness, or I guess despondent or some sort of other adjective, desperate to describe an extreme high bearish reading? What's happening right now is we're right around 50%. For me, over 50% kind of gets into that euphoric level. I have seen the indicator get up to 55, 56 or 60%, but very, very rarely. It's kind of over 50% is sort of that level for me. For me, I would never sell the market just because this reading gets above 50%. That's not enough. But for me, it's sort of a red flag, right? Extremes in sentiment, extreme euphoria readings tells me to look for signs of distribution. All right, we're so bullish. This is where sellers often come in. So let me look for signs of that rotation lower. So I think that's kind of very, very close to where we're at with the AAII survey. But to be clear, to be honest with you, this is the same reading we had last week. This is firmly in the bullish camp. This is about where we've been for much of 2024, to be totally honest with you. But if you'll note, previous pullbacks have often happened when this indicator gets above 50%, which is why keeping an eye on that here over the next week or so. The name exposure index is another one that is a survey. This one a little differently. This is a survey of money managers and asking them, what's your allocation to the equity market? And in the survey, you can respond, up to 200% long, down to 200% short, anywhere in between. And so in aggregate, respondents in the survey this week, again, almost identical to last week, around 86.6. 86%, again, is not the highest reading. That's not at a euphoric level. I would say a level over 100% is sort of the euphoric levels for me. If you look back in the last 12 months, the 3 times we've gotten above 100% were December of 23, March of 24, end of June, beginning of July of 23. And if you look at the charts, every one of those times soon after, we did get a decent pullback in the market. So what this means today is we're not quite to that euphoric level. And, again, if you're sort of an optimist here, if you're bullish on the markets, this actually would be a pretty decent bullet point on the bullish checklist, because the sentiment is constructive but not excessive, right? So a reading above 100% would tell me, wow, that's too bullish. I'd start to look for signs of distribution. This actually implies that there's a little bit of room to run, right? That there could be further optimism shown in this survey before you would start to get some concern. So the survey data, right? The AAII, the name exposure index, I would not describe either of those as excessive. If you're looking for me to tell you these are big bearish numbers, I don't think I could say that in all intellectual honesty there. All right, let's continue on. I do want to highlight the Hindenburg Omen. We have talked about this on the show on my YouTube channel called Market Misbehavior, where some of you are watching this live. I have done videos when the Hindenburg Omen does an initial reading. We got an initial reading from the Hindenburg Omen earlier this month, first week in September. The Hindenburg Omen is a set of indicators, 3 bullet points that are very common at market tops. The 3 bullet points are: we're in an uptrend. Their McClellan oscillator, as a measure of breadth, turns negative, and then there's an expansion in new highs and new lows, which represents indecision. And I have this chart which really lays out the 3 characteristics, or the 3 factors, individually, so we can see what their current readings are. And then the bottom, this is a composite indicator available on stock charts that just tells you how many of these things are checked off on any given day, and it's run after the close, after the closing data can be updated. So we are definitely in an uptrend, and the way you calculate that is a 50-day rate of change on the New York Composite Index, still quite positive. So we're good there for the foreseeable future. We have not had enough new lows to trigger that particular factor. The last time we did was early in September. This is just a little zoom in of the end of the chart, just so we can see it a little more easily. The red bars represent the stocks making new 52-week lows on the New York Stock Exchange. Divide this or multiply this by 100, and you get the percentage. This is in numerical terms, basically. So or as a ratio, and so this is negative 2.5%. That little gray line. So that's where we got below. That's where the indicator was able to fire as the initial signal. We haven't had enough new 52-week lows. So while the markets have been making new all-time highs, there aren't enough stocks sort of breaking down to trigger that particular factor. Now, until yesterday, the McClellan oscillator was also quite positive. Now, yesterday it did dip slightly below the 0 level. Today, I don't have the updated reading, but given the pop higher, given the positive breadth, I would say highly likely, if not guaranteed, the McClellan oscillator pops back above 0 today. So I don't think we're going to get that trigger just yet. Having said that, this is a chart we want to actively follow over the next week. There's about another week left on the clock for this to signal a second distribution signal. And if so, then all of a sudden the current configuration looks a lot like the end of 21 and a lot like February of 2020. And if you look back, those are your last 2 really significant tops in the S&P 500. That's why this chart is an interesting one to follow. We'll continue to follow to see if we get that second signal within 1 month. Bitcoin popping higher. I mean, it's right at this resistance level. And again, the way that I do this sort of thing with charts is I analyze the charts using the best practices of technical analysis. Then I try as much as possible to simplify, to focus on a particular level, a particular signal, a particular trigger that would tell me something's different, right? So the way you think of it is, here's my conclusion today, here's how I'm positioned, and this would tell me I'm wrong. This is something that would tell me that something's different. I've been describing Bitcoin as a consolidation phase at best and more of a negative trend at worst, because of the fact that we stalled out here in the 74,000 range. And from there, we have yet to eclipse that. I have the line here right at 70K, and we can see a number of attempts to get above 70,000 have all been repelled soon after. And we've seen a retraction lower soon after. Now, most recently, we did sort of retest that August low around 53,000. We did have a nice rally back to the 200-day moving average, which is where we've been playing with the chart here for the last week. We're also right at resistance at the August peak. So again, go back to Charles Dow's original work. Higher highs and higher lows are bullish. If we can get a higher high there, that can be a constructive development for the chart of Bitcoin. That's where I had my alert. We did technically break the alert, but we're not really following through. From that moment, we stalled out around 66,000 to come back down. So I think this chart above 65K is a pretty decent, pretty constructive chart. From a long-term perspective, you have to be concerned about the overhead resistance. And again, this chart has failed to get above 70 to 74,000, 1, 2, 3, 4, 5, 6 times in the last 12 months. That's concerning, right? But overall, again, to get to new highs, we have to get above short-term highs first. That's a level where I think you could play a retest of those previous all-time highs. All right, getting back to stocks a little bit, a couple other thematic charts, then we'll look at some individual names, then I'll grab a couple questions from the chats. And as a reminder, whatever platform you're using, Facebook, YouTube, X, just put a comment wherever you're watching the feed. I can see all of them here, and I'll grab a couple and put them on the screen here momentarily. This is what I call the newer Dow theory. This is adapting Charles Dow's original work where we did the Dow Industrials and the Dow Railroads. This is using an equal-weighted S&P and an equal-weighted NASDAQ as sort of a modernization of that Dow theory, looking at two main parts of the economy, old economy and new economy names. Are they all working or are they not? We highlighted this divergence at the end of August where the equal-weighted S&P was making a new high. The equal-weighted NASDAQ was not making a new high. What's happening very quickly is that divergence looks very close to being negated. What happens when you have a big divergence like this, the only way you get out of it is either you have the follow through to the downside, which sort of validates that divergence and tells you, yep, that was a major top, or the divergence is negated by both of the charts breaking out. It's sort of like a stock where you take a position and then you're stopped out. This would kind of stop us out of the bearish Dow theory indicator that we saw at the end of August. For me, I would need to see the equal-weighted NASDAQ get above that July peak, which means we have a little bit further to go with the growth leadership names kind of getting it done. But it's worth noting a set of conditions that did look fairly negative the first week in September, also all of a sudden looking a lot less negative. It's part of that general theme that we've talked about, the rotation away from some of the defensive sectors back into growth sectors. I think most constructively we've seen the improvement in consumer discretionary with charts like Tesla, Amazon, Home Depot breaking out nicely. We're now starting to see technology start to improve with semiconductors having a pretty decent week. Micron's earnings certainly didn't hurt, but we're seeing NVIDIA break out of a consolidation phase and so forth. Now we're seeing defensive sectors, which had been some of the strongest areas of the market July into August, now starting to rotate lower. This, by the way, is a set of 3 relative performance lines. Here's the relative strength of utilities versus the S&P, still holding up just fine. Here's the relative strength of consumer staples versus the S&P, rotating lower this month. Here's the relative strength of real estate versus the S&P, rotating lower here in the last couple of weeks. So I would say the bear case for me was really in some ways driven by the strength that we saw in defensive sectors, which is often a big warning sign for risk assets. But when those conditions change, we have to acknowledge that. And I would say the defensive sectors that were looking quite strong, and while utility is still hanging in there, consumer staples, real estate, a lot less constructive, particularly on a relative basis. A couple other charts here. Jacobs Solutions. This is in the heavy construction group. This is a group we've highlighted randomly over the last 12 months. In 2024, some of the charts in this group have been remarkably strong. There's a whole area of the industrial sector that at time has been really, really constructive. What's interesting about Jacobs this week is we're testing the previous high from March. If you look at that March high, just above $150, we then rotated lower. We've had a number of retests of sort of that 150 to 152 range. Every one of those has been repelled. Finally, it's starting to not be repelled. We're actually starting to make some headway above those. I'd love to see it clear the March high, which would become new resistance. But for now, the fact that we're starting to push above that 150 to 152 range is pretty important. A classic approach to technical analysis is look for a clearly defined resistance level, what we call a basing pattern. And the more you test that resistance, the more it validates what an important level that is. Because what that implies is that every time we get up there, either buyers are not willing to push the price higher, sellers are coming in, but we're finding a ceiling in the market. When that ceiling is broken, when the price finally goes higher, that tells you that all of a sudden investors are willing to pay a little more than they have for that period of time. And that often indicates a lot of good things to come. If you look at some of the best performers over the last 10, 20, 30 years, they always start with that resistance that then it's broken, right? We go to new highs, and new highs tend to lead to further strength. That's sort of the pattern we may be observing here. And again, I'd like to see some follow through above that resistance. It does come to mind an area like infrastructure, which I would loosely group Jacobs and other stocks as sort of a part of that play. Looking forward to the elections here. Obviously, a very contested election. The election season is heating up. I don't know about you, but I'm hearing more and more about it every moment. getting random, robo texts about different candidates and such. What you have to remember, there are certain types of stocks that will probably thrive under a Trump presidency, and others that would probably do much better in a Harris presidency. What I like to think about are those buckets, but also, so you're not sort of betting on an outcome of election, what's going to probably do well in either scenario, right? Think about what both of the candidates or all of the candidates are sort of suggesting, and things that generally come to mind are plays on lower rates, because I would say lower rates are probably going to happen no matter what, and infrastructure, because everyone is talking about improving infrastructure here in the U.S., where a lot of it needs a lot of help. The infrastructure ETF, IFRA, this is one that was introduced to me a while ago, years ago, by Larry Berman. He came on my show on Stock Charts TV. We talked about this chart. It's been sideways, all of a sudden, really starting to improve. This is a weekly chart, by the way, to go show a little bit more long-term history. But look how in the course of 2024, this ETF has done remarkably well. This is an area of the market that I would probably assume does well, regardless of who's elected. By the way, I will be doing a live workshop in a couple weeks, mid-October, October 15th. We'll talk about the elections, potential outcomes, which stocks tend to do better or worse. We'll talk about seasonality. I should have that sign up ready for you very soon, and I'll let you guys know, and I would love to have you join me there. Final chart or two. Let's go to Freeport-McMoRan. We highlighted this chart in an article we posted on CNBC Pro. I mentioned it on the show yesterday, gapping higher another 7.5% today. I like charts that are breaking out above resistance, because that often means we see a continuation. Now we're testing previous resistance, and I think that's where you have to be a little bit tentative and see if we're able to follow through there, maybe look for higher lows as an opportunity. And finally, energy, really the weakest part of the market today and for much of 2024. Charts like FANG, which is Diamondback Energy, in a continual pattern of lower highs and lower lows. That, for me, is a concern. Let's get to a question or two to finish things off here. And thanks so much, those of you watching on the different platforms and dropping some comments. Blue Larry 1674, you asked, hey Dave, the BP util is 100. How do we interpret that? Thanks so much for asking about that, by the way. That is an indicator called the bullish percent index. I actually talk about it often within the context of the broader market. We do the bullish percent index for the S&P 500. But I do have a list of charts somewhere. Here we go. Sector bullish percent indexes, utilities. You're actually mentioning this one right here. So what an indicator like this does is it looks at a group of stocks, in this case, utility stocks traded in the or members of the S&P 500. What percent of them have given a bullish point and figure chart, right? So any point and figure chart, which is a classic sort of charting technique, very simple way of analyzing trend movements to the upside or downside. When you count all of those individual stocks, how many of them are bullish at any particular time? When it gets to 100% bullish, which is actually incredibly rare, by the way, that means every one of those utility stocks are in a primary uptrend. This does not surprise me. I've not looked at this chart in some time. It does not surprise me, because we've been highlighting how strong utilities have been on a relative basis. We've been highlighting the strength that we've seen in a lot of individual stocks and the persistence of those uptrends. This on its own is not a negative sign. What often is a negative sign is when you go back below the 70% line. That's when, and this is the utility sector at the bottom, if you look at when we get above 70% and then pop below it, that usually is where a pullback is probably occurring. So for now, it's sort of a long and strong thumbs up kind of indicator. I would say the same thing for the bullish percent index on the S&P 500. Over 70% means that's great. But then it also means the end of this move probably is going to line up pretty well for when we get below 70%. So keep an eye on this one to see if and when we get back below 70%. For me, that would be a bit of a concern. Some sort of binary code in your name. Thanks for watching. I won't attempt to say that in English. We said, is SMCI in trouble? Thanks so much for asking about this one. I actually almost included that chart, and I just ran out of time. I knew I'd be running into a time crunch. Is SMCI in trouble? I mean, my answer is yeah, and I guess my longer answer, or somewhat longer answer, is that's not new, right? And I think what you have to remember about the chart of SMCI, this is an amazing chart up through the first quarter of 2024. From that point on, this chart has been showing signs of distribution. I could understand if you were still kind of, somewhat cautiously optimistic kind of in this period here. This is May, June, July, where we'd had that initial, I mean, this is when it went vertical. It was kind of an obviously euphoric exponential rise. We pulled back. Now, this is a huge percentage drop, right? I mean, we got cut almost in half, 30, 40% drop from that point to this point. But from there, we sort of stabilized, right? And then I could see, okay, let's see if we're able to build some momentum. And that's why I often talk about a basing pattern and look for a break above resistance, which never came. What did come, though, is a break below support. And I think at that point, if you own a chart like SMCI, I would argue you're using the hopium strategy and not any sort of good technical approach. For me as a trend follower, I want to buy strength. I want to buy breakouts. I want to buy improving trends, not trends that are deteriorating. So what's happened here, I mean, I think the chart's been in trouble really from this point on. I think it's been an underwhelming chart. We're now well below moving average resistance. We're well below the 200-day moving average. And we keep making sort of lower highs and lower lows. Now, the thing is, we're having quite a lot of volatility. So in the last month or two, we've ranged from 400 to 650. So this is a big swing. However, take a step back. When in doubt, zoom out, look at the trend, lower highs, lower lows. I would argue this chart has been in trouble for quite some time. I'm interested in a chart like this when I see enough signs of accumulation. I think a day like today just reminds you it's not happening yet. Folks, that's it. Thanks so much for adding the comments in there, asking some great questions. I really appreciate it. As a reminder, we go live every weekday after the close. We are planning an all mailbag show tomorrow. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Have a great night.